America's job market is flashing warning signs we can't ignore. A top economist now says what we're seeing in the labor market, industries shedding jobs, gains concentrated in just two sectors, only happens when the US economy is in a recession. So, is the recession already here? And what does it mean for your paycheck, your mortgage, and your future? Let's break it down. The latest jobs report shows the US economy barely added any jobs last month. In fact, most industries are shrinking, not growing. The only reason overall payrolls are still positive is because healthcare and hospitality have kept hiring. Mark Zandi, chief economist at Moody's Analytics, has warned for months about a jobs recession. Now he says the labor market is getting sicker by the day, and healthcare is the only thing keeping it on life support. So, where are Americans still finding work? Healthcare, hospitals, nursing facilities, and clinics are still hiring, thanks to an aging population and a post-pandemic care surge. Hospitality, hotels and restaurants continue to recover, with travel and tourism fueling demand. But outside those two sectors, the story looks grim. Manufacturing is slowing, retail is cutting back, tech and finance are shedding workers. Without healthcare and hospitality, America's job growth this year would be zero. Zandi's warning is stark. When job gains are this thinly spread, it's almost always a sign of recession. Normally, when the economy is healthy, multiple industries add jobs at the same time. Construction, logistics, manufacturing, tech, and more. Right now, most of those areas are in reverse. It's a sign businesses are cutting back, confidence is falling, and the slowdown is spreading. For everyday Americans, this isn't just numbers on a chart, it's real life. A weakening job market means fewer opportunities if you're looking for work, lower wage growth as companies freeze pay raises, higher risk of layoffs in industries outside healthcare and hospitality, and for young workers just starting their careers, it's a tougher climb, fewer openings, more competition, and less security. The job slump has essentially guaranteed a Federal Reserve rate cut this month. Wall Street is betting on at least a quarter-point cut, maybe more. But there's a catch. If inflation surprises on the upside this week, the Fed could hesitate. That creates a dangerous balancing act. Cut too little, and the recession deepens. Cut too much, and inflation could roar back. For households, this uncertainty translates into volatile mortgage rates, stock swings, and shaky confidence. So, are we already in a recession? Economists say the warning lights are flashing. More than half of U.S. industries are already cutting jobs. Consumers are still spending, but it's concentrated in essentials like healthcare and travel. Business investment is slowing, squeezed by tariffs, trade uncertainty, and higher borrowing costs. It's not the 2008 collapse, but it could be the start of a drawn-out, grinding downturn, where only a few industries carry the entire economy. The next big test comes this week with fresh inflation data and, soon after, the Fed's policy meeting on September 17th. If inflation stays contained, the Fed cuts, and maybe that buys time. But if inflation ticks up while jobs weaken, America could face the dreaded mix of stagnation with high prices. The U.S. job market is sending a clear warning. We may already be sliding into recession. The question is, will the Fed act fast enough? And will that be enough to protect workers? What do you think? Are we already in a recession or just hitting a soft patch? Drop your thoughts in the comments, like this video if you found it helpful, and subscribe for more deep dives into the economy that impacts your life every single day.